the people who are shorting this, they are having someone pay it for them, right? So this is how the advanced people do it. It's not that advanced. It's quite a simple way to do it. And that is they are selling calls to fund their puts. So you understand how that works, because when you sell your calls, you can continue to manage your risks because time becomes your ally, because you are owning the underlying stock. So you understand that because you are covered, you have time as your ally, and therefore you can continually be selling while taking the income from selling your calls to fund your puts. So someone is paying for your short position. You understand that? You are not over leveraged because someone is paying for your short position. The earlier you understand that, the better you will become as a trader. So please understand that someone is paying for your over leveraged position. And when you're shorting something, you will certainly be over leveraged, because shorting by essence of itself is taking a leverage position. You are borrowing somebody's stock and paying it back later. You understand the logic of shorting. So these are basic principles of trading. You have to first figure that out before you want to come to more advanced concepts like this.